Well, our next expert is Michael Gable, founder and managing director of Fairmont Equities. He believes that investors can do better by combining both technical and fundamental analysis. And Michael joins us now. Welcome.
Thank you.
When you're trying to find a stock that is undervalued, what are you actually looking for? I'm assuming that you're not doing this by sector. It's very much an individual stock picking.
Yeah, look, at the end of the day, we're not value investors. I'm not looking to pick up a stock that trades on a PE of 10 if I think it should normally trade on a PE of 15. So I've approached this from the point of view of what stock do I believe could offer significant upside over the next 12 months that would make us look back this time next year and think, wow, that was cheap. I really needed to have picked up some of those shares at those prices.
All right, well, as it turns out, you have picked the most shorted ASX stock.
Yeah, well, we need to go hard or go home. So this is what I've picked, and it's Paladin.
All right, tell us why then.
So look, Paladin obviously is a uranium miner, and ultimately we need to understand what's happening with uranium. So it's like if we were talking about Fortescue or Rio, we'd analyse what's happening with iron ore prices. So in this case, I'm going to spend a bit of time talking about what's happening in the uranium space. So being a commodity stock, of course we have, it's very much subject to supply and demand over time, the supply and demand cycle with commodities. So as we know, when the price of a commodity heads up over a period of time, you get a supply response, and that increased supply ends up putting downwards pressure on the commodity price, and you end up with this cycle. So in the case of uranium, I'll start off with what's happened since the early 90s, so we can really get an understanding as to where I'm coming from, why I think this is quite undervalued and can represent quite massive upside over the next 12 months. So in the early 90s, we had a situation where Russia was decommissioning a lot of their nuclear warheads. So basically you had all this uranium getting re-enriched, put out onto the market. So there was quite a bit of secondary supplies of uranium. So you've got uranium that's being mined by mining companies, and then you had this excess supply that was being offered by the Russians. So the market was awash with supply. Prices dropped quite a bit in the early 90s. And what that does is it disincentivises mines to continue producing or to expand their operations. Of course, we reach a point where you've got not much supply coming online from mines, and then eventually a lot of this secondary supply started to dry up. So in the early 2000s, we had this situation of less supply, and the market wasn't able to react by increasing supply straight away. So the utilities that were purchasing uranium started to realise this. They started to contract as much as they could, and uranium prices went up several times from there. So by the time we hit around 2004 to 2006, we're seeing big increases in the share prices of these uranium stocks. Then in 2006, towards the end of 2006 that is, we had another supply shock. So there's a mine in Canada called Cigar Lake. They were supposed to bring on quite a bit of supply in 2007, but at the end of 2006 the mine flooded, and that removed even more supply from the market. It actually took 9 years for that mine to eventually start producing. So we had this situation, very, very low supply, all the demand was there, and a stock like Paladin, based on, because they've had a share consolidation, a stock like Paladin went from about $10 to almost $90. So quite a big increase in its share price. After that point, of course, supply eventually starts to come on to meet those high prices, high uranium prices, started to subdue the prices of uranium. Then in 2011, we had the Fukushima disaster. So the nuclear reactor there in Japan was of course shut down. Japan started closing down all their other reactors, and what you ended up with was a reduction in demand, and other countries started to follow suit, especially in Europe, closing down reactors. So the demand for uranium dropped off quite a bit, and then you had all this excess uranium again because of the the disaster in Japan, all these secondary supplies that they were happy to sell into the market. Now, the reason why I'm mentioning all this is because it sets us up to where we are now. So for the several years after 2011, of course, uranium prices were so low, there was so much of it in the secondary market that it discouraged new supply. So some large mines such as Cameco and Kazatomprom over in Kazakhstan, curtailed some of their operations. Paladin, which we're talking about here, mothballed their mine over in Namibia and put it on care and maintenance mode. So classic supply and demand issues with commodities. We've ended up in a situation, Andrew, where there was a massive underinvestment in uranium mines. So then, fast forward to around sort of 2018, 2019. Once again, we're left with a situation where there's not much being mined. The excess supply that occurred after Fukushima has been whittled down, and the market's ended up in a deficit for the past few years. So if we're looking at uranium demand compared to supply out of the mines, the supply is actually less than the demand. So we've got this situation again where supply is quite low compared to demand, and usually that leads to an increase in uranium prices.
Well, if we now come to present day, in fact, we've seen both Russia and Kazakhstan withholding supply from Western countries. This as actually, as you mentioned there, demand is growing. Yet, we take a look at Paladin, and it's just gone through a production downgrade there and scrapped its sales guidance. It's come at a bad time, hasn't it?
There is actually a silver lining to their recent guidance. So because there's quite, the supply levels are quite low. As we know, Paladin's restarted the mine. They made that decision 2 years ago. They've started producing again, but they've had to downgrade their guidance recently. So what it shows is that it's very hard. It's very hard to be a miner. When you're bringing production back online, there's always going to be teething problems. So, they were guiding towards 4 to 4.5 million pounds for this financial year. They've had to bring that back to, I think it's 3 to 3.6. So it just shows that the supply response, is quite questionable. It's quite difficult to get a lot more supply. But you've made a very good point, Andrew, and that's, it's one thing to talk about the supply from the mines, but there's almost this perfect storm here for the utilities, because apart from the miners struggling to increase their supply, we've got issues coming out of Russia and Kazakhstan now as well. So Kazakhstan produces almost half of the world's uranium supply. So they've firstly had a downgrade earlier in the year. So their production for 2024 was downgraded earlier in the year. And then recently, as of several weeks ago, they've downgraded next year's production. So they're finding it hard to increase production. Then they've also indicated that they're looking to divert more of their supply away from the Western world to countries such as China. So in some numbers that were only released at the end of last week, we've seen that Kazakhstan's supply of uranium to China has increased by about 50% over the past year, and there's been a reduction in their supply to the Western world. So this is bad in terms of uranium supply. Then we've had the Russians turn off the taps. So as we know, the US was looking to turn off Russian supply after, I think it was 2028, but the Russians have turned up a few weeks ago and said, you know what, we're stopping it now, we're not sending you any of our uranium. And Russian uranium into the US is about 25% of their supply. So we have this perfect storm of supply struggling to keep up, and as you mentioned, right at the point when demand is increasing as well. So for those that follow the financial news, we've had quite a number of announcements of power plant restarts, new plants being built, the AI industry, Microsoft buying their own, essentially restarting Third Mile Island and taking all that supply for themselves. So we've got this huge demand response, supply is unable to keep up, and something's going to give, and that's going to be in the uranium price, and therefore the price in Paladin as well.
All right, so you're looking at a squeeze for the uranium price higher. Let's just bring up that share price again, the chart. And it did, the Paladin shares taking a big hit after that production downgrade.
Yeah.
How compelling is that share price right now then?
So because we look at charts, there was something, a very interesting tell there. This is a monthly chart, by the way, but if we just talk about what happened during that downgrade, the share price got hit because the short sellers, they know that, well, we all know that when a mine starts producing again, there'll be teething problems, and the short sellers were correct in that Paladin had to come to the market and say, look, we're expecting to do this, but it's actually going to be this other number instead. And the share price fell. But very interestingly, that was the low of the share price so far this year. Paladin's shares have actually been increasing since that downgrade a few weeks ago, and the number of shorts has started to go down. So from a charting point of view, I'd say that we've washed out all the sellers, and that's potentially a low. Now, what's interesting about this monthly chart is we could see that huge spike up in the Paladin share price during the last uranium bull market. And then after Fukushima, as we could see from 2012 to a few years ago, the share price went nowhere. From a charting perspective, the longer a stock builds a base or trades sideways, the bigger the move when it starts trending again. So we've had a stock that's built a base over several years. Now it's starting to get going again. We could see that on the right-hand side. And sometimes these stocks will mirror what they've done on the way down. So if Paladin gets back up to where it was just prior to that Fukushima disaster, I mean, we're looking at sort of levels above $40.
Well, I mean, you mentioned there, below 8 at the moment. It did hit that record above 90, but you're saying it could revisit those record levels.
Look, you can't predict these things, but what I do think we'll see is a situation where it gets very messy in the uranium space, where utilities, so contracting volumes this year are down 60%. So the utilities haven't been buying any uranium this year. They've been holding out. And I think one of them's going to have to blink first and go to the market. Ignore the spot price, that's quite illiquid, but when you look at the long-term term price in uranium, it has been heading higher almost every month for the past 2 years. So once they start scrambling, and once you start seeing those prices head higher, you'll get a response in the share prices. But as we know, when these sorts of things start to hit the media and you get a FOMO situation, who knows where the share price could be. I mean, I'd love it to be $90. I'd love it to be half of that. But I think what we'll see is a response over the next few months where the share prices head up. And then if things do get a bit messy, in markets, things can overshoot to the upside as well. So I think there's quite a bit of upside from here. The downside from here, as I've mentioned, the way it was trading after that downgrade a few weeks ago, to me, suggests the bad news is priced in. Now, the two things that could kill this trade, firstly, a demand response, that is a reduction in demand. It's a very inelastic market. So if you're a nuclear power plant and you're purchasing uranium for the next few years at a time, if the uranium price heads up 10%, 50%, 100%, it doesn't matter. You need to get that uranium. You need to produce the power that you're being relied upon. The price of uranium, as the cost of uranium in terms of the yearly cost of running a plant, is quite low. It's only a few percent. So I don't think there'll be a negative demand response if the price goes up. It will only be a supply response. And as we've seen with Paladin's, coming full circle back to what Paladin announced a few weeks ago, as we've seen, supply response is going to be quite difficult. Plus, we will need prices will need to be quite a bit higher from here to induce a lot of other mines to come onto market. So we're talking over the next few years of until we get an adequate supply response. So until then, things can get messy in a good way if you're a shareholder.